Hey everybody, this is Trey with another Monday Mortgage Minute or two or three. Last week we talked a little bit about APR and just exactly what all is included in your APR calculations and how to actually go about calculating that. This week, wanted to go into a little bit more about monthly mortgage payment estimations and just what all is involved in calculating that and how things are taken into account and really how you can kind of have an error in that process. Okay. So whenever you're thinking home price, right, and you're trying to figure out what sort of home to buy to fit your budget, usually the first thing that we think of, right, is what's the purchase price? Is it $200,000? Is it $250,000? Is it $300,000? It's really difficult for most of us, myself included, to really make sense of that number, right? I've never seen $300,000 just sitting in a corner in a room. Have you? So to quantify that is pretty tough. And this really sounds kind of sleazy, right? We've all had this experience at a car dealership where, somebody says, the car salesman says, hey, what's your budget? And you say, well, I don't want to spend more than 25 grand. And they say, well, what can you afford, right? What's your monthly payment? What can you afford? It's not about the price. And it's a real salesman-y thing to do, but it's kind of true, right? Because a monthly mortgage payment or a monthly vehicle payment is a lot easier for us to kind of wrap our heads around than this sort of lump sum of money that is going to take us, 20, 30 years to pay off, right? So whenever we're looking at what sort of house we can afford, a lot of that really does come down to what sort of a monthly mortgage payment you can afford. So if we assume, well, and I'm going to kind of go through an example here. So if we assume a typical, 30-year mortgage term, 5% interest rate. Now, all these are estimations, right? This isn't necessarily actual market conditions. But what I want to show you is that there are some things that your lender, whether that's me or somebody else, right? There are some things that we can estimate pretty accurately based on market conditions for that day, right? So if we know what your credit score is and we know that what kind of property that you're trying to buy, then we can estimate your interest rate and we can talk to you about your mortgage term and what sort of mortgage you're trying to buy, right? To get, whether it's a 15-year or a 20-year or 30-year mortgage, right? We can kind of make those assumptions pretty accurately. But where sometimes we have an issue is with tax and insurance estimations, all right? Particularly if you live on the coast, okay? So with property taxes and with insurance, typically what I do is I'll estimate 2.5% of the property value on an annual basis, okay, and I'll estimate 0.5% annually for insurance. And we find that that's decently accurate, but it really depends on where your property is located, right, and the school district that it's in. So, some towns, or especially if you're out in a rural community, then a 2.5% tax rate might be a little bit high. Now, if you live in Houston, then it wouldn't be super uncommon to have north of a 3% tax rate. Okay, so it's just whenever we're estimating this stuff and we're sending it to you, just bear in mind that the tax and the insurance numbers can one, drastically affect your payments, and they may change depending on the property, okay? Same thing for insurance, right? So if I estimate 0.5% for insurance, that's probably pretty accurate for Round Rock or Georgetown. However, if you live on the coast, then what you're also going to have is windstorm insurance, and that can be really expensive. Same thing for flood insurance, right? So we assume that the property is probably not in a flood zone, but it could be, and that could drastically affect what your monthly mortgage payment looks like. So let's take a look at that. Okay, let's just say that there is a purchase price of $250,000 house. Okay, so we'll just kind of go through this together. So home price of $250,000. We're going to assume a 5% interest rate. We're going to assume that it's a 30-year mortgage. All right, and then here's standard tax rate, standard insurance, standard mortgage insurance, and this is all kind of on an annual basis. All right, now if we look at what that shows as far as a total monthly payment, we've got a little under $2,100 a month, right? But what happens if the tax rate, instead of being 2.5%, is really 2.6? Okay, so 2.6. Now we've got just a shade under 3 grand a month, okay? But then what happens if we change the insurance to 1.5%? So let's say that it's in a flood zone and you've got to have windstorm insurance, right? We go from $2,100 a month to $2,300 a month, right? And that can tank somebody's qualification, and it can certainly tank your budget. So it's really important to figure out, sooner rather than later, go ahead and shop for insurance, right? Get some quotes on that. Figure out how much it's going to cost to insure a property in the neighborhood that you're looking to buy. Same thing for tax rates, right? Talk to your lender. You can always go on to the county appraisal district site and you can check specific addresses and you can figure out what the taxes are for a given property. And I just think that that's a really important step that a lot of times we miss from time to time. That's 5 minutes. That's about all the time we've got for Monday. Hope you guys have a great week, and I'll talk to you next Monday.